for markets, which might have a positive response to the dollar before it makes its way down. Now let's look at the DXY. Lo and behold, what do you see, boys and girls? What do you see? What do you see? All right? Look at that. Look at that. And that's on the 4-hour time frame, boys and girls. 4-hour time frame. That's the structure. All right? I'll go back to that projection. Look at the projection. There we go. All right? You see it? And you can see when I sent that. Yesterday at 2:30. All right? There's the projection. There's the outcome. Bob's your uncle. Boom goes the dynamite. All right? Guys, I really be about it. I'm not messing around. I keep telling y'all, my shit is the best in the city, guys. Fundamentally speaking, I know no rival. My only pressure is the tire pressure on those M4s. All right? That's the only pressure I have, is the tire pressure on the M4, because I know my shit is the best in the city, and that just validates exactly what I just said, guys. A healthy understanding of the fundamental outlay is really, really important and needs to be combined with a good understanding of how to use technical analysis. You can clearly see it, guys. In broad daylight, we had a strengthening in the dollar index because of that underwhelming effect that FOMC had. Jerome Powell gave us nothing new to work with, all right? Somebody give me my flowers. Yeah, of course, all right? Now, without further ado, boys and girls, let's jump straight into today's news, all right? It's a Thursday morning and we're seeing markets clearly looking hungover from that FOMC meeting last night, and this is as the dollar surges ahead, all right, guys? Now, factors driving this buying interest in the dollar, in my view, can be linked to a number of factors, all right, including the safe haven trade, all right, because there's prevailing Middle East tensions, guys. You need to be aware of that. There's some nuances to be observed here, all right? So, in my view, we've got prevailing Middle Eastern tensions. That's positive for the dollar. We've got the underwhelming effect from Powell not adding anything new to the narrative, telling us things we already know. Inflation is coming down to 2%. The labor market is rolling over. We're on course for a soft landing. Interest rate cuts expected in September. Nothing new in the way of things, which is underwhelming. That's also positive for the dollar, all right? The third thing, we're heading into NFP, guys. Tomorrow's NFP is really, really mission critical, and therefore it has increased risks associated with it, which is why markets are going to go risk off in anticipation of that, all right? That's three things that are positively supporting bullish momentum for the dollar. I'll repeat: geopolitical risk, underwhelming FOMC, risk off sentiment because we're heading into NFP. Big institutional funds will not place trades which are sufficient enough to move the market before they get the data, all right? That's always the play, all right? Markets go risk off. Traders tend to be conservative and want to wait and see, all right? Be that as it may, though, I want to take a bit of a different approach on this analysis as to why the dollar is moving as it has, against all the expectations, against all the grain that some may have expected to see it weaken, right? On expectation that Powell is going to come out and declare that a victory has been won. Even though he did give us a positive sign in as far as to expect rate cuts in September, like I said, that's been fully priced in for weeks now, all right? And that's the lesson that you need to take away from yesterday's trade, if anything, all right? When information has already been fully priced in and markets are fully aware of what is coming, then it tends to be an underwhelming effect because markets buy the rumor, sell the fact. What just happened last night? What happened last night? We bought the rumor weeks ago. We bought the rumor a few days ago, all right? Markets rallied all the way to the top, risk assets that is, and we got the FOMC. What did they do? They sold the fact, all right? So there's a big lesson to be learned in last night's fundamental outlay, in last night's approach towards how markets reacted. And if you're paying attention, I think I've just given you another missing piece of the puzzle to add into your whole trading journey, all right? Now, I think it's important for us to unpack the FOMC statement as well as the market reaction, all right? So if you missed the statement last night, all right, let me get this question first. Let me see what Super says. So what she's saying is, in cases where there is uncertainty, the dollar sells and risk assets are bullish. No, it's the other way around. In times of uncertainty, the dollar is the one that will be exuberant and risk assets will sell off. All right, so you've got the equation inverted. So guys, in as far as last night is concerned, it was widely anticipated that the FOMC would leave the interest rate unchanged, all right, at the conclusion of that meeting that we had. But what we saw, or what we can take away rather from FOMC last night, is that the door is really open now, wide open for the Fed to cut interest rates at their September 18th meeting, all right? I'll concede that inflation does remain above that 2% target from the Fed, but it has fallen significantly, guys, since the committee last raised rates about a year ago. That was the last interest rate we got. Shout out to Brianna. Late, but better late than never, all right? At the same time, guys, we've got the labor market cooling off, all right, sufficiently, and it now resembles pre-pandemic levels. So in as far as jobs are concerned, we're seeing a normalization in the rate of employment, in the strength of the labor market and the health thereof, right? It's come back to those pre-pandemic levels. Now, in its post-statement meeting, rather, or post-meeting statement, I fumbled those words, all right, which is the most important part, right? We all knew that interest rates were going to remain unchanged. There's about a 5% probability that we could get a rate cut last night. And I said, even though it is possible, it is likely improbable, all right? Highly improbable. Now, what we were all waiting for was the post-meeting statement for any new information, all right? And what Jerome Powell gave us is that he notes that the improving balance between employment and inflation goals are growing more closer together. So essentially, they're becoming more mindful to the risk that the labor market is at right now, all right? They're attentive at first, all right, so I run the risk of getting ahead of myself, all right? Let me unpack this for you guys, all right, because this might be a bit high level. Guys, the Federal Reserve has two mandates, all right? Its dual mandate is keeping inflation at acceptable levels, which is, in other words, maintaining price stability. Secondly, it is to create maximum employment, all right? Now, 2 months ago, or 2 to 3 months ago, the main focus has been inflation. Inflation resurfacing has been the immediate risk. Now that we are down to 2.5%, as per the PCE reflects last week Friday, the balance of risk now lies in employment, all right? We need to look at these NFP figures now, right? Because we went from a time when good news was bad news for risk assets, all right? Because we needed the labor market to roll over. We needed slow economic growth in order to bring down inflation closer to that 2% target. And now that we are within an inch of that 2% target, sure, 50 basis points is quite a bit, all right? We still got 0.5% to go up until we get to the target. However, the balance of risks now shifts towards the labor market, all right? Because the labor market is losing jobs at a rate that is not alarming yet, but should it get to a point where it's alarming, now the risks become maintaining the health of the labor market as opposed to doing anything and everything to fight inflation, all right? Because the medicine can't be worse than the illness. Okay, guys, even though you have to slow down and break the economy before you can fix it with higher interest rates for longer, you can only do it for so long up until you start causing a recession. And that's what the Fed wants to avoid, all right? Now, that's what Jerome Powell said last night, and I quote, he says, the Fed has become more attentive to the risks to both sides of its dual mandate rather than previously only noting its attention to inflation risk. What does that say? It says that if we get a really bad jobs report, guys, it is going to be terrible for the US dollar, because what that does is it forces the Fed into a position where they now have to reconsider the timing and the scale of their interest rate cuts, all right? Because you need to think of it this way. In times when there is low economic growth and they want to stimulate the economy and create jobs, they need to drop interest rates. In times when there's high inflation and they need to bring down consumer spending, they hike their interest rates, all right? So we're at a period where we're coming down from high interest rates, all right? And they want to pivot towards lower rates. Now, ideally, the Fed wants to do that. They want to do that at their own pace, all right, without any undue pressure, because what that does is it forces them into a corner. Now we're beginning to come into a tricky phase where the balance of risks now becomes maintaining the health of the labor market, all right? We still want to see slow economic growth, slower consumer spending, but not at the risk of destroying the labor market and finding non-farm payroll adding under 150 jobs, all right? We need to now, our homework is as such now, right, guys? If you want to stay ahead of the curve, here's the time for you to take out your pen and paper, guys. Your homework. If you want to understand what the baseline is, all right, what it means when the NFP level is acceptable and when it's not, go back in time to a period where we had below average job growth, all right? Look at what that number is. And once you find that number, compare that to what we're going to get tomorrow, all right? Because if we get a figure that is, I think the expectation is about 170 something, if I'm not mistaken, all right? I could be wrong, hardly ever, but I could be. Nah, I'm not wrong. Surprises. 177, all right? 177 is expectation. If we get something closer, well, below 150, then I believe that the Fed might begin to raise their eyebrow, and that might begin to be the focus, and as far as the balance of risks are concerned, all right? Shout out to I'm Queen Carolina, you are late, but it's okay, all right? Let's keep going. Now, in my view, it appears members of the Fed are likely wanting to still see a bit more data before moving on the interest rate cuts, all right? Because what they want to do is thread the needle, guys, all right? A lot of good work has been done in getting inflation down close towards the 2% target, and they don't want to undo all of that by cutting rates too soon and having a resurgence of inflationary pressures again, all right? And that's why, in my view, I think that some of the members on the Fed want to see a few more data sets, all right? 1 to 2 more NFPs, 1 to 2 more CPIs, 1 to 2 more PCEs, all right, in order to thread the needle. And I think that Jerome Powell arrived at a fair compromise last night, all right? He's holding rates steady at this meeting. However, he did send a very clear and a very overt signal to the market that rate cuts are coming soon, all right? And as it stands, markets are pricing in 25 basis points of interest rate cuts at the next Fed meeting, which is supposed to be on the 18th of September. Another further 25 basis points cut in December, and then rolling over into 2025, 100 basis points expected. Now, what I will say is that you need to take that with a pinch of salt, because this landscape is ephemeral, guys, all right? There's a lot of moving parts, and in my view, I think we might just get 2 to 3 interest rate cuts because of the labor market. Inflation is coming closer towards that 2% target, and the labor market is looking, well, not looking, but it could begin to look precarious. And should that happen, it'll force the Fed into a corner, and they will have to give us more cuts than the market is expecting, to give that exuberance and to give the market, to breathe a bit of life into the labor market, all right? Let me know what you think of that, whether you agree, disagree. Comments down below. Always looking forward to engaging with you guys. Now, lastly, guys, let's talk about the reaction we see on markets, all right? Now, I'll end today's stream the way I began it. In the absence of nothing new, markets are always going to be underwhelmed, all right? Particularly at such a big market moving event, all right? I warned you guys yesterday that if Jerome Powell doesn't introduce anything new to the narrative, such as increasing the amount of projected cuts from 2 cuts to 3 cuts, then it would ultimately end up being negative for risk assets, all right? And the main reason is because all of this information has been priced in, guys. We've been talking about this for 4 to 8 weeks now, all right? And if we know it, everybody knows it. Well, not everybody. We should give ourselves some credit, all right? We're a bit ahead of the curve here in the Daily Pulse. However, I'm talking about markets, economists, institutional traders. If we're already talking about this, then I can bet your bottom dollar they are too, all right? And like I said, markets are forward-looking in their nature, all right? They buy the rumor, they sell the fact. And that's exactly what happened last night. The rumor was bought a few sessions before, and the perfect, well, in as far as gold is concerned, let's even look at that, all right? I can tell you when the rumor was bought. You can clearly see these reactions on my chart. All right, let's look at it real quick. All right. Towards the end of July, I think we're looking at the 25th of July. All right, so we're talking about a week or two ago. All right, just a few days ago. That was the time to buy the rumor. Higher high, higher low, higher high. This is where we sold the fact. FOMC, boom. And now we're going to find a pullback potentially to come and meet this previous lower high before moving on up to create a new high. As you can see, boom, boom, third touch over there. So bearish on the, well, not bearish on risk assets with a view to be bullish. Okay, a lot can happen between today and tomorrow, but and as far as gold is concerned, that is my immediate or short-term projection. Shout out to Mohammed Yassi. I know you're watching, my boy. So yeah, guys, that's what we have for today. Let me know what you guys think in the comments down below. All right, I think I broke it down pretty nicely for you. I gave you a thorough analysis. I gave you a mainstream view of what happened, and I gave you the goated view. All right, and the goated view prevailed. I showed you the projections from yesterday. I called it. I don't pride myself on always being right all the time. However, it feels damn good when I am. I won't lie. All right. So yeah, it's time for you guys to give me your comments down below. I'll wait with bated breath. Queen Carolina says, dapper wardrobe all week, sir. Listen, I didn't come here to play, guys. This is a Wenzandla. I didn't come here to play. All right, I need to look like what I'm talking about. But yeah, thank you. Forex Territory says, Manji, clean. Lovely, lovely, lovely. Devuno _ Palmer says, what do you think of NFP tomorrow? I think if you get a lower figure, it's bullish for risk assets. If you get a higher figure, it depends how higher it is, but if it's below 230, I think it's still decent. Above 250, then we might be a stronger dollar. All right, it depends on the scale of that figure. All right, let's keep going. Offensive Cash says, excellent one. I'll be too. My nigga. We got the Beamer boys in the building. More offensive of Beamer, too. You must introduce yourselves to the decent offenses, all right? The ones I know, Beamer boys. That's what I'm saying. Ray JT says, which key indicator do we look at or consider when analyzing NFP? You could look at JOLTS. Look at the JOLTS job openings. I think they were lower this month. We're seeing the number of vacancies, no, higher, all right? We've got higher vacancies than expected, all right? The expectation for the vacancies in June was almost 8 million flat, and we got 8.18 million, right? However, the month before was higher at 8.2 million. So the labor market is showing signs of moderating. There are less vacancies available than the previous month, even though we beat the forecast. So check the JOLTS, check second quarter GDP, check retail sales. Also look at the inflationary data, all right? All right, Van says, just out of interest, how come we don't look at Euro and GBP data? All right, so great question, by the way. Superb question, one I get not too often, actually, but I should have been getting this question because I come on here and I talk about the US dollar all day, every day. The reason why I choose to talk about the dollar, guys, is because I'm a simple guy. I prefer dealing with one problem, all right? If I can understand the strength or the weakness of the dollar on any given day, then that gives me the latitude to trade any risk asset against it, all right? It's not too many moving parts. I'm keenly aware of the political landscape in the US. I'm keenly aware of the geopolitical risks around the world in relation to the dollar. I'm keenly aware of monetary policy in the States, the Fed members. So for me, it makes more sense and it's easier to manage, to understand what's happening in the US economy than it is in Europe or in the UK. In Europe, there's way too many moving parts. How many countries are contributing towards the Euro bloc? Quite a few, all right? There's too many moving parts. GBP data, I can only use that to trade the pound, all right? But if I understand what's happening on the dollar, I can trade everything across the board. That's what I'm saying. All right, let's see. Oh, Kamo, this is a new one. All right, this is a new one. Kamo, I haven't seen you before. Happy you are finally part of the group. All right. She says, is September still the big deal? Because a lot has happened that kind of disturbed the market. Your view, please. I think that September is still firmly in focus, guys. In the absence of seeing inflation resurface again and rebound, then I think September stays on the table, all right? The only thing that can take September off the table is a resurgence in inflation, and I don't see that happening, particularly because of the way the jobs data is pointing, particularly because of retail sales data, all right? All the forward-looking indicators are pointing towards a slowing economy that can facilitate and give the Fed enough confidence to cut interest rates on the 18th of September. Give us at least the 25 basis points on the 18th of September. So that's what I think. I think they're on course to achieve that soft landing that they've been looking for, which is bringing down inflation without causing a recession. All right, Kamo? I hope that makes sense. Great question, by the way. Superb. All right, so Bar says, online mentorship is how much? You need to DM me. You need to DM me for such, bro. All right? Let's do this every day, bro. I do, Tumelo. Tumelo, where you been? I'm here every day, bro. Shout out to Gozi. It's been a while, my G. We got Nigeria in the building, guys. Shout out Gozi, my G. All right? It's nice to see you, bro. Giovanni says the forecast is 176, though. No, it's not. It depends which source you're looking at it from. Different economic calendars have different expectations because they're polling different economists. The one I'm looking at says 177. The one you're looking at says 176. But I think we're still in the same average, all right? So yours is not wrong. Mine is not wrong. It's just different people's opinions. Nobody actually knows what the actual figure is going to be. These are just estimates from the different people they asked opinions of, all right? So if you look for it on Forex Factory, you'll find maybe a different number. Look at investing.com, you might find a different number. The Bloomberg forecast might be different, all right? Different economists have different metrics that they use to come to this number. So maybe that's why there's disparity between our two figures. Iceman says, any take on NAS 100 since yesterday's event heading into tomorrow's NFP? I think that we are still bullish in the long term on risk assets, all right? Particularly if we get a lower number as per the expectation tomorrow. I think we will. Honestly think we will. Tomorrow looks like it's a clear trade. In my view, it's as simple as it gets, guys. The Fed has already given us the missing piece of the puzzle. We're getting the interest rate cut in September. The jobs data, if it comes in lower, will just validate and amplify everything that was said to us last night. All right. Queen Carolina says, the breakout from this bearish trend on gold is so serious and the new bull rally is confirmed with corrections in between for gold swings. This girl knows how to trade, guys. This girl actually knows how to trade. All right, that's all I'm going to say. You know exactly what you're doing. I don't even know why you're here. All right, Mr. Musako says, with the BOE having interest rate announcements in a few hours, I assume they will take a similar approach as the Fed. On top of that, how will it affect risk assets such as gold? So when it comes to the pound interest rate decision, what you guys need to factor in, right, particularly speaking for the pound versus the dollar, is that if the BOE decides to move on an interest rate cut today, then the pound is going to fall, guys, all right? Because you need to think about it logically. Let's check the interest rate for the pound right now, actually, while we're just at it. Okay, we know the Fed is 5.25% to 5.5%. BOE interest rate. All right. BOE is sitting at 5.25% as well, all right? So if they move by cutting their interest rates by 0.25 percentage points, their interest rate will then effectively be at 5%, all right? Meaning, if you take £1,000 and put it in the bank for 12 months, they're only giving you 5%. Versus 5.25% to 5.5% that the US is giving, all right? So if you do the same maths in dollars, it'll give you more. And that's why the pound will sell off against the dollar, because the dollar will be more attractive, all right? Because it's pretty simple, guys. investors are greedy. More is more. This is the one industry, guys, unfortunately, size matters here, guys, all right? Bigger is better when it comes to this, all right? Bigger is bigger, all right? And investors, they want the biggest ROI. All right, Mr. Masako, great question, though. Great question. All right, Ray JT says, how's the new streaming system coming along? I'm having a challenge using it on the Alpha Markets accounts because I figured out why it keeps breaking down while I stream. Because there's too many of us logged in on an account. Jason is logged in on that account. I'm logged in on that account. The marketing team is logged in on that account. The support team is logged in on an account, dealing with support queries. So the fact that there's so many of us using one account at the same time means that I cannot stream the way I want to with the new ideas that I have for now. Okay, up until I found a solution, I guess we'll go back to the tried and tested, all right? Because I don't want to be pissed off because my camera equipment is not working and the stream keeps breaking apart, all right, guys? But yeah, Ray, great question as well. I am cognizant of that, all right? Raven says, great explanation. Shout out. Shout out, shout out. All right, Ray, road to Bloomberg, guys. All right, guys. If y'all, how can I put this? Y'all have the power to make this one of the most biggest shows in South Africa. You guys are aware of that. Like, y'all have the power to make the Daily Pulse the biggest in South Africa. All right, because no other broker is doing this, guys. No other broker is having someone come at you Bloomberg style every day, unpacking the data. So if you guys want this to grow, if you guys want this to really be a cherishable asset that we can all fall behind, then please support it, share it, tag people. Let's take it to the moon, okay? Because I think it's a true segment that's of value, all right? I'm not just coming here to bullshit you guys because I work for the broker. No, I'm actually giving you guys dope insights that are applicable in real time and in real life, all right? So make of that what you will. Choice is yours. All right, let's go. Queen Crown says the dollar may struggle until the November election or until another bombing in the Middle East to trigger oil prices and instability in the Chinese markets. The girl is up to date. The girl is definitely up to date. I bet we're almost done. Ah, there she is. Shout out to Leanda. Oh my God. There she is. Dewuno says, do you trade in dollars? No, I like to see my money in rands. Shout out to Dylan Peterson. What's wrong with me? Dylan Peterson, all right? Shout out to the big G, all right? G47 in the house. What does CCSI say, guys? I need to go back to that. What does CCSI say? Everybody's just laughing. What the hell did CCSI say? Now I gotta scroll up again, and I was almost done. I'm just curious. Where is CJ? And what did you say, nigga? Sorry, guys. I need to see this. I need to. I know CJ's always saying some crazy shit. I can't find it. Damn, I can't find it. Someone else will just let me know what he said. All right. But yeah, let's keep going. I'm just breaking down all the comments. Almost done, guys. Time frames for day trading. I stick to 5 and 15. I execute on 5 and I monitor on the 15th. On the 15th. All right, Quincy says, how might the current geopolitical tensions affect NFP report and broad economic indicators? So the market long-term already on monetary policy. What geopolitical risks present is short-term volatility, all right? While we might see a short-term strength or exuberance in the dollar, the market is always correct and they will be led by monetary policy. It's all about the interest rate, guys. All right, Tata says we'll do whatever it takes to raise the daily pulse movement. Shout out. What time frame was that on the DXY? That was the 4 hour, my good sir. Mafia Loso says, Why you see I've been spreading word, but people don't show up, but they're complaining when we show off. Bro, let's just keep sharing, all right? Keep taking screenshots, keep recording me while I speak, and just share this shit, man. Just share this shit. I'll always repost it. I always do. All right. For someone looking at understanding economic data, where would you suggest one should start? My technical is looking a lot better lately. Now I want to learn economic data. Listen to Bloomberg. All right. The more you listen, the more the right information will come at you, and you'll be able to process it eventually once you start drawing the connections between the different points of economic data and the reactions on those assets that you're trading. All right, and that's it, guys. Fastest 30 minutes online, and I am out, guys. Thank you so much. Mr. Mahaya, you late, Sly? All right, you are late, sir. All right, Iceman says, Sisha Sai, he said tomorrow's NFP, you'll see live stream numbers playing around 200. Yeah, for real. People only come when they want to use us, guys. These people are using us, guys. Eh? I'm telling you. These people, they're not here every day like you guys are. We get to build this narrative. So, I'm always saying that, guys, I need you guys to comment because I take every talking point into the next session. All right, so we're collectively creating the narrative here. And those people just want to come and join and get the benefits of what we have been laying out for weeks now. I mean, how long have we been tracking all of this stuff, guys? We've been tracking this for weeks on end.